Teladoc Health stock has been absolutely clobbered, down something like 70%, despite the fact that they continue to post really strong growth. The question is, will the stock start to bottom? I personally own a stake. I'll talk about that and the underlying business in just a second. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did in fact own stock in TDOC or Teledoc. TDOC is the ticker for Teladoc Health, so I did own stake in Teledoc. So TDOC has what I love to see in potential multi-baggers, and that's the goal with this channel, is to find those potential companies that can go up hundreds or even thousands of percent over time, which is that you have very fast growing, business. Here it is, they're up over 100% through the year-to-date 2021, through the first 3 quarters, with a declining share price. I already mentioned down something like 70% from its high. And you can see how their valuation, this is a price-to-sales multiple, has really come back down to earth. This got this huge COVID bump, and everyone thought, oh, telehealth going to the moon. And this is the challenge. As you see business accelerating, the reality is you shouldn't give a significant multiple expansion, because you need to ask yourself, will this business continue to accelerate in the years ahead? If not, you can end up like a situation just like this, where here it is, the multiple is actually lower than what it was before COVID. That is a really interesting data point to see. And this is, in my mind, this is one of the key aspects of a playbook of finding potential multi-baggers, is looking at valuation compression, despite the fact that you're looking at significant growth and secular growth for this business. And that's part of the reason why I own a stake in TDOC. So as a quick recap for those that aren't familiar with it, so Teledoc is the largest virtual healthcare services business in the world. They have thousands of corporate clients, which include over 50% of the Fortune 500, as well as major health plans and hospital customers. Through these clients, they provide telehealth services to tens of millions of members through both organic investments, so making bets that they're investing in on their own through their own engineers, as well as mergers and acquisitions, so buying other companies. They've rapidly expanded their coverage of solutions. So this is both in services that they've expanded their coverage from, just offering, let's say, primary care to now whole person care, to geographically as well, where they're looking to target new international markets. So they're expanding coverage in both the service that they offer, as well as the markets that they target. So I'd argue, by building out their solutions over time, offering more and more of a comprehensive solution, it does put them in an advantageous and potentially unrivaled position for telehealth services. It would be really hard for, let's say, a new player to come in and try to compete with them when they offer so much. And, you start having this sort of geographic reach as well, where, let's say, you're looking to enter into a new market, and they're sort of saying, well, what other markets can you prove yourself in? Oh, yeah, we've already done it. So there is this broad aspect of, oh, you cover a lot, and if someone wanted to compete with you and offer the same service to one of their customers, they'd say, well, do you offer all this as well? It also seems like a win-win formula, as employees get better healthcare options and the employers potentially save money. So employees benefit from the ease and accessibility of telehealth, and employers potentially save money with this healthcare solution. So part of the appeal is that telehealth services is that they potentially save, let's say, hundreds of dollars on average for each general medical visit versus receiving healthcare in the other, let's say, in-person setting with a similar diagnosis. And they did their own study a few years back saying that on average it saves something like $470. So the vast majority, to understand their business model, so vast majority of their revenue, 86% of their revenue, is from customers. So these corporate clients and hospitals and healthcare plans paying an access fee per member or per employee, while visit fees and their other revenue is a much smaller, that's really the remainder of their business. And having so much in effectively access fees should create a strong recurring revenue stream for Teledoc in the years ahead. Now, while the stock price is down significantly, and I think a lot of that is just the valuation returning to sanity, after this sort of blow off where everyone's like, oh, telehealth is going to be great, because of COVID, and they weren't thinking longer term. It was very short term oriented. management still expects, despite, what you'd argue is a terrible stock price action, management's still saying, yeah, we still think we're going to post, really strong growth in the years ahead, saying 25 to 30% annualized, up through fiscal 2024, where they're targeting about a $4 billion plus revenue target. But this begs the question, wait a second, how are you actually going to grow 25 to 30% annualized? How will they possibly achieve that growth if their underlying members, so the underlying, let's say, folks that are using it, that are covered with their access fees, only grew by 2% in the third quarter 2021? Like that seems like a huge mismatch. The answer is that while members might only grow, let's say, 1 to 5% per annum, which is what they're targeting here, they intend to upsell these clients of theirs with additional services, and they think more revenue per member at the equivalent of 25% per annum. So let's dive into that a little bit greater detail. So while primary care, let's say, might only grow, let's say, 10% in the years ahead going forward, they can also layer in this additional coverage, additional services like mental health or chronic care. Chronic care can be, chronic condition care like diabetes, hypertension, weight management. These are big and fast-growing telehealth opportunities that might be growing, let's say, 30 to 40% going forward. And when you factor these components in, you might be looking at a consolidated growth rate that's much more attractive. And that's really the key aspect here. Okay, so what about the valuation? First, a quick plug. Or if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord where I interact daily. You can sign up at unrivaledinvesting.com. Click Join the Journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. And so once again, that's at unrivaledinvesting.com. Click Join the Journey. And if you enjoy videos like this, please make a point of hitting that thumbs up, hit that subscribe button. And so thinking about Teladoc's valuation, so TDOC, they come across as significantly unprofitable at first when you're looking at their valuation. I suspect the long-term reality, however, will be different as they continue to scale. First, their gross margins, so looking at their revenue less the cost of revenue, is around 70%, which is great. It's a little under that. That said, they are investing significantly in things like advertising and marketing and sales, which is 30% plus of revenue. Honestly, that surprises me a bit. Maybe at maturity, this could end up being significantly less, resulting in profitability for shareholders. Similarly, their investment in general and admin costs, that's around 20%. Longer term, I would expect that to scale as well. Maybe that gets to closer to 10%. They get some operating leverage as this business gets bigger. So longer term, wouldn't be surprised to see Teladoc as significantly profitable, maybe 20 to 30% operating margins longer term. Until then, it is a legitimate risk that needs to get baked into the valuation. On a free cash flow basis, they are, I think looking at their free cash flow, they are profitable or doing a solid free cash flow, but that's, function of DNA and stock-based compensation, not really a core function of their underlying business. So I'd like to see it on their income statement as well. So another aspect when you're thinking about their valuation is that while management has been very focused on expanding their service coverage, which increases their value proposition to customers and potentially puts them in this unrivaled position, the reality is that they may not be great at capital allocation. They may not be great capital allocators, and that's a really important element in which you judge management. And, the deal valuation that they paid for Livongo, not too long ago, you're looking at, 2020, that was around $18.5 billion valuation with the combination of cash and stock. That deal value for Livongo alone is now worth more than the current market cap of TDOC combined. So that combines Teledoc with Livongo. So that does sort of show that the market says, whoa, you way overpaid for Livongo. And in all honesty, that's how I came to hold a position in TDOC. Is I originally bought Livongo. That worked out very well. And so I trimmed the vast majority of my shares with Livongo as it got the buyout offer. But I still have the Teladoc shares, some of the Teladoc shares that I got from that deal. And so what about the valuation from here for Teledoc, recognizing that it trades under that $18.5 billion valuation that Livongo got? At the current price, if management executes, that's a big if, I think it has the potential to more than double over the next 5 years, maybe 100 50% upside, maybe. That said, stock prices can, of course, go higher and lower, but it all depends on execution and sentiment. If they miss, let's say, on their growth and upselling, then I would expect a lackluster or worse performance for the business. This hypothetical valuation framework, this is really sort of saying, what can this business do if they execute? Because I want to say, can I pencil out, using a rational framework, something that says, yes, this is attractive, and I think this business can do well over time. A lot also depends on them proving that they can get to these 20% operating margins that I'm assuming here. 20 to 25% is what I'm assuming here, which I think they'll be able to achieve, or at least very, very well signal that they'll do that in the next 5 years. They can say, oh yeah, we're increasingly profitable. And you should note, as I think about the let's say the growth rate over the next few years, this is partly based on management's guidance. And you might say, well, wait a second, Daniel, isn't that really conservative given the fact that they're growing, let's say 80% plus, implied for fiscal 2021? And the reason why is this includes the acquisition of Livongo, whereas their organic growth rate's closer to 30, 40%. And so assuming, let's say, annualized growth of 20 to 30% is in line with that, current organic growth rate, that doesn't give them the benefit from that Livongo acquisition. And so while I like what Teledoc is trying to build, I suspect and I own other health-related investments with more asymmetric returns out there. I've called them out as potential multi-baggers for Journey subscribers. One was a company a few months ago that trades at like 10 times free cash flow. Now it's closer to 12 times free cash flow. Another is a company with hyper growth growing over 200% that I think has several 100% upside. So those are the types of things that I'm looking for. Yes, I still own Teledoc. I still like the thesis. It's not a major contributor here. So I think I'll continue to hold my teaser position, sort of track what's going on with Teledoc. I'd absolutely love to hear your thoughts. If you have a strong opinion, if you feel like I'm dramatically missing something with Teledoc, or you think the upside's way greater than what I'm penciled out, I definitely want to hear your thoughts. And if there are any unrivaled companies that you feel like I should be moving up the list and making a video on, leave a comment below, because I want to hear what's that unrivaled business that I haven't looked at and why is it unrivaled. If you enjoyed this video, please make a point of hitting that thumbs up button and hit that subscribe button. Thanks so much for tuning in.